Hello guys and welcome to Stocks by Night. I am Nox and this is the first episode of my new series on SPAC stocks. To start things off, we have a look at SPACs in the EV bus and fleet industry. The stocks in focus are these 6 listed here: ARVL, Lightning eMotors, Lion Electric, Proterra, and 2 companies in the electrification business, XL Fleet and Hyliion. I will analyze and compare them to find out which stock presents the best value for money and the best opportunity at this moment. First, I will speak about why it seems promising to look at SPACs right now and the current market situation, providing a bit of motivation for the series. Then the opportunity in the EV fleet sector. Next, I will present the tickers in a nutshell, so their business, financials, and a summary with my take or evaluation of their business model regarding proof of concept, ability to scale, and moat or competitive advantage. Followed by an overview and comparison of their business models, their valuations, and my price targets. So why SPACs and what is happening in the market right now? The year 2020 was the year of SPACs. It seemed these special purpose acquisition companies were a sure way to make money in the market. As soon as a target was announced, they jumped 30-40% above their IPO price, FOMO kicked in, and a lot of new SPAC IPOs were issued to benefit from the trend. In 2020, more SPACs were created than in the prior 10 years combined, and the numbers kept accelerating in early 2021. A bubble was brewing. But then in April, the SEC got involved and issued accounting guidance that would classify SPAC warrants as liabilities instead of equity. This makes this alternative IPO vehicle less attractive in general, and moreover, existing SPACs need to correct previous financial statements and evaluate warrants each quarter rather than just at the issuance. This caused SPAC IPOs to come to an abrupt halt, and the bubble popped. SPAC valuations dropped hard, which was exacerbated by an ongoing stock market rotation out of growth stocks at that time. As you may remember, treasury yields spiked in February and everyone was freaking out because of looming inflation, dominating all the headlines and media articles. As inflation causes interest rates to go up, capital gets more expensive and future cash flows get discounted more heavily. For these reasons, growth stocks were selling off and money was rotating back in value stocks that are cash flow positive already, ideally give dividends and one need to raise capital. As a result, high growth and SPAC investors got screwed and keep getting hit. No fun times indeed. But hey, a bit of dark humor brings us through dark times. Actually, the tide seemed to be turning again for a while. Growth stocks got way oversold and bottomed in May. Money has been rotating back as the Fed tries its best to keep inflation expectations in check. And while growth stocks had been picking up again for a while, they just got beaten down once again due to higher than expected inflation numbers in the CPI data. And SPAC stocks are still lagging, and some of them are starting to trade at really attractive valuations and might offer good value propositions at the moment. This is why in this video series we will have a look at different SPACs and see which ones might offer a good opportunity. In this first episode, we'll look at SPACs in the EV transportation sector. But why looking at the EV bus, EV fleet sector? Well, let's look at its opportunities. As the consequences of climate change get more and more aggravated, like the heat wave in the US or the current floodings in Europe, cutting back on CO2 emissions will dominate politics in the years to come. And road transport makes up roughly 11.9% of global greenhouse gas emissions worldwide. So it's definitely up there on the political agenda. In the US, transportation even makes up for almost 30% of greenhouse gas emissions. Zooming in, these 30% are mostly caused by light-duty vehicles and medium and heavy-duty trucks. This creates an opportunity for EVs. More than 20 countries have announced a full phase-out of internal combustion engine car sales over the next decades. Over 10 countries already by 2030, and more than 120 countries aim to reach net zero emissions economy-wide over the next decades. Also, the US takes action. Already 15 states are targeting 100% of all new medium and heavy-duty vehicle sales to be zero-emission vehicles by 2050, and an interim target of 30% of zero-emission vehicle sales by 2030. Initially, Democrats were pushing for $25 billion to electrify school buses as part of Biden's $2 trillion infrastructure plan. However, under the current plan of a smaller $1.2 trillion infrastructure agreement, electric bus initiatives would only receive $7.4 billion instead of the $25 billion. But we will see, there are still ongoing discussions, and either way it would be a boost for the sector. Here's some numbers on school and transit buses in the US context. There are about 70,000 transit buses and 480,000 yellow school buses, of which only a very small fraction, around 2% or 1% respectively, are zero emission. The Center for Transportation and Environment estimates that the full transition to zero-emission buses for the US transit fleet would cost between $56 and $88 billion, so you can see why they are pushing for more funds. The really important takeaway message here is though to realize that we are just at the very beginning of the EV revolution. In 2019 there were only around 8 million electric vehicles on the roads globally. By 2030 a minimum of 138 million electric vehicles is expected under currently stated policies, and even 245 million for a sustainable development scenario, when the countries would fully commit to the climate goals of the Paris Agreement. Here the numbers without passenger vehicles, only focusing for commercial vehicles such as buses and trucks. The projected growth percentage-wise is here even bigger. So, great opportunity for sure. Let's now go through the tickers, summarizing what they are all about. First up, ARVL. The stock is currently trading around $30.5, more than about 60% down from its highs during the SPAC bubble. The company was founded in 2015, so a relatively young company, has around 1,700 employees, basically working around the globe. Their headquarters is in London, but they have people in the US, Europe, Israel, and Russia, trying to offer their products worldwide. Regarding products, they have none yet, but they are planning an electric bus, van, large van, and small passenger cars, focused on ride-hailing services. Here you find the expected production starts for the different products, starting with the electric bus in Q4 this year. So yeah, the company is very early stage, but at least the concepts for their vehicles look very nice compared to others, actually futuristic or what I would picture EV vehicles to look like. This is their bus, their van, very clean, minimal design, and their car, which will be purpose-built for ride-hailing. They also already have interesting partnerships in place. For their vans, they entered a strategic partnership with UPS, so they designed the vans according to their requirements and optimized them for package delivery with feedback of the drivers. In turn, they already got orders for 10,000 units. The delivery of prototypes starts in 2020. You can watch videos of the prototypes on YouTube. It seems to be working fine and the UPS drivers are really happy with it, at least on camera. For their car, they are collaborating with Uber to help them to reach their fully electric mobility platform in London by 2020 and by 2030 across North America and Europe. Again, Uber drivers join the design process to make sure the vehicles suit their needs for ride-hailing. In stark contrast to the gigafactory approach from Tesla, the company will use a microfactory approach. According to the management, these small footprint, low-cost microfactories with roboter-based manufacturing will allow them regional production, removing complex and expensive global shipping and allowing them to cut 30% of costs. According to the projected timeline, the microfactory in the US will be production ready in Q4 this year, the one in UK following in Q3 next year, and others will follow. This is their microfactory in the US, South Carolina, to manufacture their ARVL bus later this year. And here a picture of the van microfactory opening next year close to Oxford. The vehicles are designed such that they can be manufactured with robots off the shelf and in-house software. Also, they use composite materials with an in-mold color, removing the need for large footprint paint processes. Their approach is based on modular and in-house plug-and-play components connected by software and upgradable. Their key components, such as the modular skateboard platform, can be used across multiple classes of vehicles and are ready for mass production. One point I want to highlight is that according to their website, 90% of their employees are engineers and half of those are software engineers, meaning 45% of all employees are software engineers. While software clearly plays a big role in their approach, I'm a bit concerned, or let's say curious, whether they will be able to execute. Luckily, they have experienced strategic partners on the manufacturing front with Hyundai and Kia, but I'm still curious to see how they will execute on their plans. Definitely a very interesting approach and also a sustainable one. Unsurprisingly, regarding their employee statistics, they also put emphasis on their digital ecosystem and software, which I'm sure will be very helpful to provide features relating to ride-hailing as well. They also see software as a service as a future opportunity, for example by offering driver applications or fleet optimization tools. That the company is indeed very innovative also shows in their patent activities. While they state that they have a patent portfolio of about 180 innovations, according to IP Query, 27 patents have been registered so far. They received $660 million in cash from the merger, which they are using to fund growth and production. And they are expecting to grow really quickly, with a compounded annual growth rate of 291% over the next 3 years. Their microfactories should enable low capex production, enabling them to be cash flow positive already in 2023. And an EBITDA margin of about 23% looks good for the industry. They expect to make half of their revenues from their vans. So in summary, what am I thinking about their business model? Well, they are just in the process of transmission from testing and prototypes to actual commercial manufacturing, using a very unique approach with their microfactories. So there is a lot of risk involved and a lot to be proven. Therefore, proof of concept is unclear at this stage, stage. Apparently so far everything works as planned and their components are production ready, but a lot can go wrong from concept to mass production. However, I'm optimistic and really look forward to see how they are performing. They have the ability to scale in theory, thanks to their microfactory approach, which I really like. But again, it first needs to be proven to work. And if things work out, their business also offers an economic moat or competitive advantage. Production is usually very capital intensive and needs years of preparation. So there are high barriers to enter such markets. Moreover, their approach and their partnerships give them an edge over their competitors, and their vehicles actually look decent compared to others, with their minimalistic and futuristic touch. Taken together, it's a great concept, but very early stage and a lot of risk. Next up, Lightning eMotors. The stock is currently trading at 669, also down about 60% from its high. By the way, I like their ticker. It's usually used as an acronym for Zero Emission Vehicle. Lightning eMotors are basically the opposite of ARVL. Small company with about 100 employees, only targeting North America, a bit longer in business since 2008, and with their approach they actually try to front-run companies like ARVL. Their idea is to offer fully electric solutions today, gathering market share among blue-chip customers who want to start electrifying their fleets now. For this, they are powering familiar commercial vehicles with their powertrains, and they buy rather than manufacture, so a very pragmatic approach. They provide complete electrification solutions for urban commercial fleets, which means short-haul vehicles, so for short distances. They also offer charging and financing solutions. So they focus on short-haul medium-duty vehicles in all types of vehicle classes. And with their approach they were already able to gather market-leading share, offering a way broader range of vehicles than their competitors. Even offer custom applications such as ambulance vehicles or ADA shuttles, making sure there is an electric solution for any type of vehicle. But as I said, they buy rather than manufacture. Basically, they buy the chassis, bodies, and batteries from other companies. They have a long list of partners, for example buying batteries from Proterra, and other supply chain partners for their drivetrains, repowering, or even fuel cells, so hydrogen-based EVs. So what are they actually doing themselves? Basically assembling, adding software and also some parts to make their powertrains work. Here's some of the Lightning eMotors built content for one of their powertrains. With this front-running strategy, they are quite successful in gathering market share, which is already over 50% across vehicle classes 3 to 7. They also offer charging infrastructure, and they also have some pending patents, among others for a mobile charging station, which they call Lightning Mobile. This so-called Lightning Mobile should make sure that no vehicles will be stranded. It looks kinda gimmicky to be honest, but it does solve an actual problem, especially in the US, as the charging infrastructure is not covering all distances nationwide, given today's range of EVs. On the other hand, this is somewhat symbolic for what the company represents, a pragmatic solution for early adopters of EVs. So I see their company shining now in these early stages of EV adoption until more sophisticated approaches or more futuristic EVs are production ready and the adoption starts to accelerate. Let's take a look at some financials. Their projected revenue growth looks very attractive, with a 195 compounded annual growth rate for the next 5 years. Their margins suffer from their buy rather than manufacture approach, but at least from 2022 onwards, their costs are expected to drop heavily due to volume and supply chain maturity. But their EBITDA margins are still relatively small, and it will take them until 2025 to be cash flow positive. They stated they are projecting the cash from the merger to be sufficient to fund operations through 2022. However, they will not be cash flow positive by then, so they will likely need more capital to fund their operations, which means probably more share offerings and dilution for the years 2023 to 2024. So look out for that. Their balance sheet looks a bit skewed, lots of liabilities, but this is mainly because of the warrants from the merger. Also, they will be using some of the cash from the merger to pay down some of the debt and to fund growth. In summary, they have proof of concept, they can offer electric solutions for pretty much all medium-duty vehicle classes. However, their buy rather than manufacture approach with only 100 employees limits their ability to scale. Although they have lower capital expenditures up front, which would be associated with manufacturing, it takes them a long time to be profitable, so I'm not really convinced here. They do have somewhat of a moat. Their whole idea is to offer electric solutions for early adopters and gather market share now among the blue chip customers, hoping for repeat orders, which so far is very successful, but once more sophisticated solutions are available from original manufacturers, I see them losing a lot of market share. The problem is they are not vertically integrated and do not have a competitive advantage in their EV technology like batteries, because they just buy it from the market. So I have to say, for the long term, I would not bet on this company. The next company is Lion Electric. electric. In contrast to Lightning eMotors, they focus on manufacturing. The stock is currently trading around $15, also about 60% down from its high. It's a Canadian company also serving North America. They focus on designing and manufacturing medium and heavy-duty urban vehicles, also with well-known blue-chip customers for their trucks and buses, and they also produce school buses. Beyond the vehicles, they also offer essential services for fleet operators to switch to electric, such as charging infrastructure, analytics tools for cost savings, and the grant team helping customers to find the right funding solutions. For their charging stations, they partner with a bunch of global leaders in the space. They have 7 types of trucks and buses already available today, and 8 new models are joining their lineup over the next 2 years. They have a significant order book for their vehicles and charging stations. They deliver their vehicles as things should be. So they are an established company with more than 390 vehicles already on the road, a growing order book of Tier 1 clients, and the full turnkey solutions for all aspects of fleet electrification. And they are also expanding their capacities. The $500 million they got from the merger will be used to fund growth. Their growth strategy includes expanding manufacturing capacity. In addition to their production facility in Canada, they are ramping up a highly automated production plant in the US by the next year. Additionally, and in the same time frame, they are building a battery plant to assemble their modules and packs, which I really like to see, as manufacturers will struggle to keep up with the demand for batteries when the EV revolution is picking up the pace. Looking at their financial forecasts, they show great revenue growth numbers, growing on average 280% over the next 4 years. The EBITDA margin of 20% is also fine, and they are cash flow positive from 2023 onwards. I'm not a fan of their balance sheet though. Although some of their liabilities, like the warrants, are due to the merger, and the $500 million in cash from the merger will be more than enough to cover the rest. The share-based compensation liability seems way too high for the small revenue numbers they are currently making. I will be following these numbers in the next earnings reports. In summary, the company has proof of concept. They are already producing and delivering their products, for which they already demonstrated favorable total cost of ownership compared to diesel alternatives. And they are able to scale production, as they are already in the process of expanding their production capacity, and they broaden their product line with 8 new vehicle models. Also, there is a clear moat. Again, high barriers to enter, as production is very capital intensive. They have a first mover advantage in all electric medium and heavy duty urban vehicles, so also rather short haul vehicles with 8 years of experience. And the factory in the US will be the largest vehicle plant for all electric medium and heavy duty vehicles in the US. Now let's talk about Proterra. The stock is currently trading at $11.9, also about 60% down from its highs. They are a US based company also focusing on North America with around 530 employees. They are focused on advancing electric vehicle technology. Specifically, they build high performance batteries and drivetrains for heavy duty vehicles. They initially applied their technology to build their own transit bus. Later on, they started to provide their batteries and drivetrains to other commercial vehicle segments, and also provide fleet charging and energy management solutions. Their technology is proven, and their transit bus has a 50% market share in North America. Their battery system is modular, can be stacked, and are available in different lengths, perfect to scale across many different vehicle segments. Here an overview of the different products they offer to original manufacturers. For example, they also supply Lightning eMotors with their batteries. To get an idea of the market opportunity for the different types of vehicles, here is a list with the annual unit volumes. However, their business model relies on original manufacturers to outsource their powertrains or battery strategies, which most of them do anyway. However, most of the manufacturers of excavators are vertically integrated. Assuming these numbers will look the same when the industry goes fully electric, the picture with the market opportunity from before changes a bit. So the market potential, especially for these global excavators, might not be that huge as it seemed. On the positive, Proterra already has partnerships for the different vehicle types. For some they are already delivering, for others they are starting production soon, as you can see down here, and others start a bit later. For example, commercial production for the hydraulic excavator is planned for 2023. Their manufacturing is modular and scalable, which enables them to even expand at customer sites. So for example, when they enter a large partnership, they could locate such a battery factory at customer sites. Proterra's success critically depends on their technology, engineering, and innovation, for which they currently have 81 patents. They also have ex-Tesla employees in their leadership team, for example the COO, Josh Ensign, or Dustin Grace, who oversees the battery development, have both worked for Tesla, which also becomes kind of visible in their first principles approach to engineering. So it's not surprising that in some articles Proterra Proterra has been called the Tesla of bus manufacturers. Their battery system is vertically integrated, and they also plan to get into battery cell manufacturing. While they secured battery cell supply through 2022, they are also looking to partner up for a US-based cell production. The cash they got from the SPAC merger will be partly used for that, and also to continue to fund their R&D investments in the next generation battery program, which will help them to unlock new commercial vehicles and also bring down the cost significantly. Specifically, their next-gen batteries will allow them to also target long-haul solutions. This would be really a milestone. Regarding Proterra's charging solutions, there are also a few things to highlight. First off, they offer energy as a service financing and battery leasing, meaning customers can choose to invest upfront or pay as you go. In this case, Proterra would keep the ownership of their systems and only charge the customers for their usage. This is a huge advantage in the industry, as it helps customers to lower their costs upfront and facilitate the switch to electric for fleet operators. And also, their charging solutions allow for vehicle-to-grid integration. This means power can also flow back from the battery of the vehicle to the grid. This enables power grids to use parked fleets as energy storage and balance out power demands. This not only helps to stabilize power grids overall, but also unlocks new revenue opportunities by transforming electric vehicles basically into grid assets, lowering the total costs of the fleet operators. And of course, they offer charging solutions for all fleet sizes and already installed more than 450 charging solutions. Currently, the energy business already makes up 13% of their revenue. Taken together, Proterra is well positioned for a huge addressable market for both vehicles and energy solutions. Looking at their numbers, they already make good amounts of revenues. Their revenues grow consistently about 70% year over year, and their EBITDA margins will reach about 20%, also looking good. But it will still take them a while until they are profitable. The first profit is expected in 2023, and they are cash flow positive in 2024. Even without the cash from the merger, their balance sheet still looks fine. Chamath is also invested in Proterra and called it his biggest investment in climate change. He attached his investment thesis to the tweet. In case you are interested, I will link it in the description down below. In summary, the company has proof of concept, their electric transit bus is the market leader, and their batteries and powertrains are already in use. However, it will be critical for the company's success that they keep performing and successfully develop the next-gen battery system for long-haul vehicles. They have great ability to scale. They can offer their energy solutions to a wide range of vehicle classes, and they are able to quickly deploy battery factories at customer sites for bigger partnerships. They also have a clear moat. Again, high barriers to enter, they are vertically integrated with leading technology, great engineering, they are protected by patents, and they offer the perfect solutions for fleet operators, even with a pay-as-you-go option to lower upfront costs, which seems unique in the industry. They have lots of experience in partnerships with customers across a wide range of vehicle classes. Overall, this business model looks very promising. The two companies left, XL Fleet and Hyliion, are both in the electrification business. This means they turn existing combustion engine vehicles into electric vehicles or hybrids. XL Fleet currently trades at about $669, about 80% down from its high. XL Fleet is a rather small company with 95 employees, already operating for 12 years, based in the US and targeting North American markets. Their vision is to become the world leader in fleet electrification. Gotta have ambitions. They currently offer hybrid solutions for a wide range of vehicles, plug-in hybrid solutions for some, and fully electric solutions are in development. They are planning to offer hybrid, plug-in hybrid, electric, and even fuel cell electric vehicles. Fuel cell meaning powered by hydrogen. Basically all platforms and vehicle classes. They have an established track record for their hybrid solutions and a broad base of blue-chip customers. They are quick to develop hybrid solutions for new chassis by modifying their powertrains with their parts. This is the typical manufacturing process. The original manufacturer builds the vehicle, some upfitter delivers the custom body, XL Fleet adjusts the powertrain, and voila, the final vehicle is delivered to the customer. They have a network of production partners all over North America to install their powertrains. So according to their website, you can go to any of their partners on the map and have their systems installed within 6 to 10 hours. These partnerships give them a large scalability and accessibility for customers. With that many partners that are installing their products, it is important to protect their intellectual property. After they got hit by a short sale report in March, they mentioned in their refute that they have a rich patent portfolio including 25 issued patents, which is good to hear. Also, the management was very quick to address the short seller report. The short seller report came out on March 3rd, and their response was there on March 4th, which as a shareholder it's really nice to have a responsive management. Anyways, they also offer charging infrastructure, but there is not much information about it. Here are the plans for using the cash from the merger, for example, developing EV solutions and investing growth. Looking at their forecasts, they project large numbers of revenue growth, on average about 200% over the next 4 years. The EBITDA margin over 20% is also looking good. The balance sheet looks fine, the cash from the merger is already on it. So in summary, XL Fleet has proof of concept regarding their hybrid product. However, it is unclear whether they will be able to offer competitive fully electric solutions in the future. For their existing products, they have a good ability to scale, as their powertrains can be installed by any of their large number of production partners, so that seems very easy. Regarding their moats, it is a bit unclear whether their patents protect technology that would give them an edge over their competitors in the electrification space, but at least they do have a first mover advantage for their hybrid solutions, with 10 plus years of experience and an established customer base. So for the short to medium term, before fleets are switching to fully electric and may choose to electrify their existing fleets, this business does seem promising. But for the long term, in the space of fully electric vehicles, I do not see a competitive advantage for the company, as they are not vertically integrated and probably won't be able to provide unique solutions. Last up, Hyliion. The stock is trading at around $9, more than 80% down from its highs. Hyliion was founded in 2015, counting about 120 employees, is US-based and also targeting North America. Hyliion focuses on heavy-duty trucks and produces electrified powertrain systems to either improve or replace traditional diesel or natural gas fuel powertrains. The goal is to reduce emissions without sacrificing performance or reliability. They offer a hybrid diesel solution and also a hybrid compressed natural gas solution, which helps to save fuel, lower emissions, and in the CNG case, in the natural gas case, even adding horsepower and torque. Their hybrid solutions are available today, but they are also working on a fully electric solution, their Hypertruck ERX, which would allow for about 35% cost savings compared to traditional diesel trucks over a time span of 7 years. Their Hypertruck will be adaptable to the source of fuel. The goal is to have it be running based on hydrogen once the fueling infrastructure for hydrogen is ready. In the meantime, the truck will be running on renewable or compressed natural gas, or both natural gas and hydrogen, so fuel agnostic. Here are some statistics regarding the fuel costs, infrastructure and emissions. Natural gas is cheaper and more charging stations are currently available than for electric or hydrogen-based vehicles. Also, the emissions would be lower. However, this is only true for renewable natural gas or biogas, and this type of gas is not as available as the compressed natural gas. But the supply is growing, and apparently the renewable gas, the RNG, already counts for about 50% for the natural gas fuel use in the US. As to date, the Hypertruck would beat the competition in terms of range, payload, capacity and charging time. Here the timeline for its launch. Demonstration units are currently being built and should be ready in the second half of 2021. Commercialization and volume production is expected for next year. Tesla is expected to deliver its first semi-truck by the end of this year as well, so there is a close race between the two, and this is for a reason. In the vehicle class 8 for the long haul, Tesla would be the only competitor right now to Hyliion. Here they're partners for production and development. The company Dana, for example, helps them with manufacturing and the electric drive components. But Hyliion has their own battery management system and also protect their intellectual property. Hyliion has currently filed for 26 patents according to this source. Now let's have a look at their numbers. First off, they received about $520 million of cash from the merger to fund growth. They stated that no additional capital would be needed prior to commercialization and production, which is good to hear, so no dilution is expected. Their revenues are expected to really take off when their Hypertruck is launched, and they expect to grow well above 100% for the years to come. Their margins look really good. Their gross margin will reach about 35% and the EBITDA margin almost 29%. This is really good for this industry, as we will see. The balance sheet is also looking really healthy right now, thanks to the cash from the merger. In summary, Hyliion has proof of concept for their hybrid powertrains, but it remains to be seen whether they are able to deliver their Hypertruck and whether it can be fueled by hydrogen. I am very optimistic though. Their ability to scale is a bit of a question mark, but they should be able to scale as they are not manufacturing the trucks themselves, only the powertrains based on fuel cells or batteries. And looking at their forecasts, their manufacturing partner Dana should have enough capacity to meet demand and to grow at the expected rate. Their their Moat is looking good. They offer the only hybrid solution for long-haul trucks, soon also the only fuel cell option, and next to Tesla Semi, the only fully electric option. And of course, their technology is protected by patents. To some degree, an investment in Hyliion would be a bet or a hedge for the possibility that there is a future for hydrogen vehicles. But even if not, their trucks could run on natural gas. So I like Hyliion's approach of an adjustable or fuel-agnostic truck, which makes it a bit more future-proof. Now for the final part, I will compare the 6 stocks based on their business models, their valuations, and also give some price targets. Here an overview of my take on their business models that I explained before. Also a subjective rating of the risks involved. The more rings or circles, the riskier, and here my personal ranking of these businesses. My first place goes to Proterra. They still have to develop their next generation battery cells, which will be an important step to open up a wide range of new possibilities for expanding into long-haul vehicles, which is why I see some risks involved. But overall, the business model offers great ability to scale and a high competitive advantage. The second place goes to ARVL. However, this really depends on your risk preference, because it is really risky. At this stage, they have no product in mass production, so they have a lot to prove. But the concept in theory is great. Apparently, their parts are production ready, so we will see if they actually will be able to perform. Already in Q4 this year, the production for their bus should start. But yeah, when realizing production, a lot can go wrong, so expect really wild swings in this stock. My third place goes to HYLN Electric. I would say it is a relatively solid EV manufacturing play. They already produce 7 medium and heavy duty vehicles and are expanding their manufacturing capacity and products. My place 4 goes to Hyliion. Also very risky, as their success crucially depends on the Hypertruck that is expected by the end of the year and entering mass production starting next year. Next to Tesla Semi, which is expected by the end of this year as well, Hyliion's Hypertruck is the only alternative for an electric long-haul truck and the only hydrogen play. Between Lightning eMotors and XL Fleet, it was a really close battle for the last place. I'm not a fan of either of them, to be honest, but in theory, XL Fleet has a better business model. However, I do not view them to be future-proof. There's also not a lot of information, and I have too many open questions relating to their business and products, especially regarding their future products. But if they perform on their forecasts, the business would look good, at least for the next 4 years. And last place, Lightning eMotors, is relatively low risk in the short term. They have a pragmatic approach, but their business model of buying rather than manufacturing keeps the margins low, and it just does not look attractive to me. Despite gathering market share now, it does not really give them a competitive advantage for the future when the technology of the products will decide who's the winner, because they are not vertically integrated, they are just buying their products at the market and assemble. So yeah, I do not see them having competitive advantage for the long term. For comparing the valuations, I took the forecast from the SPAC investor presentations and look at the values at the end of the projection period to have as much information as possible. So the forecast period ends for all companies in 2024 except for Proterra, where it goes to 2025. So this is important. These multiples and values are based on 2025 for Proterra and 2024 for the others. So the price targets will also be for different years. Keep that in mind. The earnings multiple is given by today's market cap divided by the EBITDA for the year at the end of the projection period. So 2025 for Proterra and 2024 for the others. The revenue multiple is given by the current market cap divided by the revenue for 2024 or 2025 in the case of Proterra. Here also the revenue growth for this last year of the projection period, which is highest for ARVL and lowest for Proterra. Then the revenue multiples accounting for the revenue growth is given in this column, followed by the gross margins and the EBITDA margins. The margins look best for Hyliion and are the lowest for Lightning eMotors, which was expected due to their buy rather than manufacture approach. To visualize the evaluations and compare them a little easier, what I like to do is to take the revenue multiple divided by the revenue growth, as a higher multiple might be justified by the higher growth, and also the EBITDA margin, because in the end the earnings will matter for the valuation and the business also needs to provide cash flow, and then I plot these two indicators in a graph. So on the horizontal axis is the revenue multiple divided by the revenue growth. The lower the value, the better, and the EBITDA margin is on the vertical axis. The higher the value, the better. So the best opportunities should be in the upper left corner of the graph. The bubble sizes are weighted by the revenue value for the last year of the projection period. What we see in this graph is that Proterra is trading at a bit of a premium compared to the other companies, even though we are looking at 2025 numbers for Proterra and they have kind of a 1-year advantage here. What we also again see is that Hyliion has the best margin, Lightning eMotors the worst, and what stands out the most is that Arrival is trading at the lowest valuation, has high margins, and the largest revenues in size. So this is looking really interesting. So from a valuation standpoint, Arrival looks actually the most attractive to me. But let's look at what would be a fair price target for these companies, taking into account their earnings and growth. So basically both axes here. What I like to do to get an idea of a fair price target, I want to calculate a fair earnings or EBITDA multiple, which we can derive as follows. A PEG ratio of 1 is generally considered to be fair value, which means the PE ratio should be equal to the company's earnings growth. So taking the EBITDA multiple as proxy for the PE ratio, a fair EBITDA multiple should equal the EBITDA growth. And to calculate the expected EBITDA growth, we can multiply the projected revenue growth times the EBITDA margin, which gives us these fair multiples for 2024 or 2025 respectively. Dividing these fair multiples by the current multiples gives us the company's potential increase in value, these multipliers here. We can take this multiplier to calculate the implied revenue multiple by multiplying it with the current revenue multiple, and also the implied price target by multiplying it with the current stock price. So these would be the fair price targets according to the forecasts. Note that the fair revenue multiple is lowest for Lightning eMotors, which is due to their low margins and relatively low growth. In contrast, Hyliion's and Arrival's fair revenue multiples are higher, so they deserve a higher revenue multiple due to their higher growth and higher margins. These numbers confirm the observation that Arrival seems to offer great value for money at these prices. The market cap could be about 16 times higher in 2024 if the company is able to deliver on their forecasts. Of course, the company is also the riskiest of the bunch, but that looks like a very interesting risk-reward structure to me. Hyliion is also a very risky bet, but could also end up more than 10xing. Since Proterra is trading at a bit of a premium, it would offer about a 3.5x from this point. The risk-reward seems decent, but also note that the price target for Proterra is for 2025, so it takes them a year longer to get there than for the others. Lion Electric with a potential 5.6x seems quite solid based on these numbers. And even XL Fleet seems to be at a really attractive valuation, even though I do not really like their long-term outlook. But Lightning eMotors, also from a valuation standpoint, just does not look really interesting to me given its long-term risks. However, these numbers are based on the forecasts in the SPAC investor presentation, representing best case scenarios, and therefore they should be taken with a grain of salt, because there are two caveats. The first caveat is that there might be possible dilution in the future, which seems very likely for Lightning eMotors as explained before, but also with regard to the SPAC mergers, there might still be convertible notes or warrants that lead to higher shares. The number of pro forma shares outstanding in the investor presentations was higher for Lightning eMotors, Lion Electric, Proterra, and XL Fleet. Proterra's value could, for example, dilute by as much as 16% because of this. Hyliion's current shares are already higher than the estimate given back then in the SPAC investor presentation, so there has already been some further dilution. Caveat number 2, the big threat, is that the forecasts are too optimistic and the actual results fall short. So look out for the earnings calls, check the numbers, look for changes in the timeline to adjust the forecasts. Also check analyst estimates and see if they are in line with the company's forecasts. And if at all, build your position slowly as you are getting more and more confident that they are actually delivering on their promises. As an example, I checked for current estimates by the analysts for these stocks. For Arrival, the analysts estimate about 17% lower revenues for 2022. For Lightning eMotors, the analysts' estimates seem in line with the future revenues in 2022, which is good. But for Lion Electric, on the other hand, the analysts expect nearly 30% lower earnings in 2022. For Proterra, the estimates are only about 7% lower for 2022, so it's fine. But for XL Fleet, the estimates are over 80% lower. So I'm really curious to see how this one plays out. And for Hyliion, I did not find any updated analyst estimates. If you have access to some, you can check yourself and then maybe adjust the valuation accordingly. Because adjusting the numbers for these estimates and the potential dilution would lower the price targets as shown here. According to these numbers, I would not touch XL Fleet, and also Lion Electric lost quite a bit of attraction. Arrival still looking very good though, and Proterra still solid. But again, it also really depends on whether you believe these analysts' estimates. So what I would recommend is make your own impression of the company. So follow the earnings calls, look at whether their earnings are in line with their forecasts, and so on. Please also note, if you want to take into account the analysts' estimates, you would of course also need to lower then the multipliers and so on, but due to space constraints only did it for the price target here. So do not take the price targets at face value. Again, the forecasts are taken out of the SPAC investor presentations, which paint the best picture future possible to attract investors. However, if the risk reward looks good to you and you believe in the business and the management team, there might be some great opportunities here. I hope this video was helpful for you. In case you have any questions, let me know in the comments. Thank you guys for watching, and I will catch you in the next one.